Hello Freedom Builders and welcome back to the channel. It has been a while since the last video and today we're going to have a quick look at a couple of stocks that were picked from our automated strategy that is called the Quality Momentum Strategy. As you can see, it has done fairly well, 9.2% overall for the strategy this year. The overall market, the equal weighted S&P 500 is up around 7%. So this is a fairly decent strategy, I would say, with a reasonable max drawdown of 7%. And since this is a quality momentum strategy, we would expect to see that the average stock in this strategy has high quality and high momentum, which also is the case. Now, these strategies are picking specific stocks from specific criteria every month, reallocating every month, and I'm going to have a look at a couple of stocks that it picked just this 1st of May. The first one is Amphenol Corporation here. And have a look at it. We see why it was picked for a quality momentum strategy. It has a quality of 94, meaning it is better. It has a higher quality on our criteria, better than 94% of the other stocks in US, and momentum better than 89% of the stocks in US. So overall, a fantastic stock. Now looking at the stock here in TradingView, we can see that we picked it up here on the 1st of May. And this is a good picture of what trend following is, because you don't necessarily have to pick every stock right at the bottom. It would of course have been nice to pick it down here, but we got in around here and we are now up somewhat to 10-11%. Now looking at the stock, if I were to go through our normal 3-point playbook, it is not 100% certain I would have picked it up. First of all, it has a PEG ratio of 4.6. If you have seen many of our videos, you know that we like that to be around down around 2.5, meaning that we are not paying too much for future growth. However, the Altman C score is fantastic. It's very safe. The analyst estimates say somewhere between buy and strong buy, and we can see that they have increased their estimates over the last months here. Also looking down here, we can see that return on capital employed and return on equity is some very good numbers here. There's some great coverage of the dividend. We can see the cash flow is going up. We can see that the current ratio is good. We can see, well, overall, this is a very good stock, very good interest coverage. So a stock that we are happy to have in our portfolio. However, we are not speculating on when to sell because we are simply getting that told directly by our automated stock strategy. So if the quality momentum strategy next month tells us that another stock is even better, well, then we are just replacing the Amphenol with another stock. But until then, we might keep it for a month, 3 months, a year. As long as it keeps staying in top of our criteria for this strategy, we will just keep it. All right, the other one we bought here the 1st of May is Garmin. Now let's have a quick look at Garmin, also over here in TradingView. As you can see here, we went in on the 1st of May, and that was unfortunately not here. This was the 30th of April. So we got in here. I can't recall the exact price, but of course we wouldn't have gotten in at the very opening price. So let's just say that we got in here at the middle, depending on when we were lucky to enter, we would get somewhere around 7-8%. Now, it might also be that the strategy itself actually calculates it from the very start of the day here, meaning we are up 11%. But then again, it did go down a bit over the day, so we had the opportunity to get in at a better price here. But that is always when it is calculated by an automated algorithm. It might be some fixed prices. On the other hand, if it had dropped from here, we would also have had this as our entry price. So that comes to about the same. Now, looking over here, we can see quality of 98, momentum at 89. That is fantastic. It doesn't have a PEG ratio because the earnings per share growth is estimated to drop by 15% in 24 and then go up again by 7.7% in 25. So that is another reason why I might not have picked this one up myself, might have picked another stock. We can see that the price to earning is not insanely high. Altman C says it's very safe. Analyst estimates not quite into buy, but almost, and we can see they have increased their estimates over time here. Decent return on capital employed and return on equity here. Free cash flow is growing quite handsomely here. Interest coverage, we don't have these numbers here, not entirely sure why not. Should have been here, but it might be something about this structure. They actually have a net debt that is negative, so that might be the reason. All right, but overall, two very good stocks, although stocks that I might not have picked up myself because we are going through our very rigid rules in the 3-point playbook, where we are point 1, looking at, is this a decent stock, a solid, good growth? Is it priced correctly? I haven't even looked at the value charts today, but I have a feeling that with the negative earnings per share growth and the high PEC ratio in the Amphenol stock, they might not have shown some very good long-term value, meaning we probably wouldn't have gone into them. So overall, would I have entered them without our strategy? Probably not. But then again, that is the strength of an automated strategy. You don't have to think too much. We have done all the thinking for you, and you just need to follow the rules. That's all for now. I hope this was inspirational. And remember, this is a walkthrough of a couple of stocks from the 1st of May. So this says absolutely nothing about if the stock is a good buy now or not. So that is entirely up to you. If you haven't tested MyStockScanner before, jump into the link below the video here. Have a 14-day free trial and see if it is something for you. That's all for now. Take care of yourself and your money out there. I'll speak to you again shortly.